Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Friday, March 27th, 2026, and the vibe flipped hard to risk off. Tech cracked. The generals led the retreat and semis did the heavy damage. This wasn't panic, it was de-risking. High beta growth took the first hit, while money quietly leaned into energy and a few defensive pockets. On the S&P 500 Heatmap, it looked like a sea of red, especially where it matters most for index weight. The deepest drawdowns were packed into megacap growth and semis, NVDA down about 4%, Meta nearly 8%, and Google off more than 3%. Apple was basically flat, slightly green, but it didn't offer much shelter. The clean green pockets? Energy stood out, plus a few defensive names that stayed bid while growth got liquidated. That heat map is basically a rotation map. Money moved out of crowded, high-duration growth AI, semis, megacap internet, and into areas that look more cash flow and defense. Energy led, utilities showed spots of strength, and selective healthcare held up, and this was not a clean rotation into broad risk. Small caps didn't suddenly take the baton. It was more hide in what works, not buy more beta. Here's the tension that defined the session. The market suddenly demanded a risk premium again, and crowded growth didn't get a pass. When names like NVIDIA, Meta, Google, Microsoft, and Tesla are all read together, it stops feeling like a stock pricker's tape and starts feeling like a positioning unwind. By the close, it felt less like a washout and more like a forced reset, degrossing into the weekend with speculative corners also backing off. On the chatter front, there was no specific verified market rumor in today's notes, so we're not going to invent a story for why the tape moved. If headlines are driving intraday swings, treat them carefully. Separate what's confirmed from what's just circulating and watch price action for what the market is actually willing to pay for. Welcome back to Cat Eye. If you bought the so-called peace rally earlier this week, today was a brutal wake-up call. The Nasdaq plunged about 2.3%, officially entering correction territory as the Trump peace plan hit a brick wall. Tehran has formally rejected the 15-point U.S. offer, and on the ground the war just escalated. An Israeli strike in Bandar Abbas took out IRGC Navy Chief Alireza Tangsiri, the man behind the Hormuz blockade. In response, Iran has turned the strait into a literal toll booth, reportedly extorting up to $2 million per tanker for safe passage. That's why Brent Crude is ripping toward 107 tonight, with shipping insurance premiums up about 500% and roughly 13 million barrels a day still offline. The market's finally realizing this isn't a short-term blip. It's a structural energy shock. Keep your eyes on the 10-year yield at about 4.42%. It's suffocating tech valuations and signaling that higher for longer is the only path left for the Fed. Meta was the standout downside outlier, down about 8%, and it mattered because it read through the whole megacap internet complex. The notes flag investor sensitivity around spending and the AI investment narrative. When a name like this breaks hard, it's not just one chart, it's a check on whether growth multiples are still being tolerated in size. NVIDIA was down a little over 4%, and the key is what it represents. The analysis calls it the market's AI risk-on proxy. So when it's getting sold in size during a semi's liquidation, it tends to drag the broader growth complex with it. Today, that made every bounce attempt feel like a sell-the-rip invitation. AMD got hit even harder, down more than 7%, as the semiconductor complex liquidated. The write-up flags it as a clean sentiment gauge for higher beta, so-called AI second derivative trades. When AMD is getting dumped like that, it's usually telling you risk appetite is being pulled, not rotated. TSM dropped more than 6%, and that's a big signal because it sits at the center of the foundry supply chain. The notes describe heavy supply as global semis went risk-off together. When TSM is down hard, it reads like a system-wide repricing across the chip stack, not a single-name problem. Exxon EXOM was up about 1.3%, and on a day when growth was bleeding, that was your rotation tell. The notes are explicit. Traders leaned into energy as an inflation hedge and cash flow pocket. EXOM staying green while tech sold off reinforced that the market was hiding in energy, not buying the dip in semis. Apple was basically flat, slightly green, so it showed some relative stability. The notes frame it as a selective quality megacap parking spot, but the real story is what it didn't do. It couldn't offset the broader AI and megacap selling, and if even the steady names start rolling, breadth risk ramps up fast. Looking ahead, the calendar is heavy. Monday morning, Fed Chair Powell speaks. Tuesday brings jolts and consumer confidence. Wednesday, ADP, retail sales and ISM manufacturing. Thursday, jobless claims. Then Friday's big one, jobs data, with payrolls, wages, and the unemployment rate. After today's degrossing feel, the setup is simple. Do semis and megacap growth stabilize, or does energy and defensive leadership keep running the tape? Today was a leadership problem. The generals sold with the troops, and the market leaned into energy and defense instead of chasing a tech rebound. Into next week, watch breadth and the quality of any bounce, especially in semis and megacap internet, because that's where the tape either stabilizes or stays in unwind mode. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.